Hi, my name is Bruce Roth, and today my guest is Dave Horwoodell. Dave is an enrolled agent and the founder of Torchlight Tax. Dave, for our viewers, can you give us some examples of when they would or wouldn't be able to deduct their automobile from their taxes?
Right. Well, the automobile as a tax deduction it's deductible if it's used for business. Now, usually your largest business tax deduction will be, if you're using that, will be to count the actual mileage. And you actually have to keep a record of your personal mileage versus your business mileage, because the IRS is going to ask that. But if you do a lot of business...
They only ask that if you get audited, though. Is that correct?
Not correct. When you file your tax return, you're supposed to put those numbers on.
Well, you just put the totals. You don't have to put the actual log.
Yeah, you don't have to put the log, but you had to put, okay, 6,000 miles personal, 5,000 miles business. You know, you have to actually put those figures in there for them. And, you know, whether you have a log or not, yes, you're supposed to keep a log, but you have to turn those figures in with your tax return in order to get the deduction.
Okay. And are there times when you would want to not take mileage?
Yes. Let's say that you're in a business where you're dealing with some very upscale clientele, and so every couple of years you buy a new Cadillac, or you're leasing a Cadillac, something like that. You'll probably get a larger deduction in that circumstance with the actual expenses of the Cadillac. But for most people, and especially for people who are doing a lot of mileage in their business, you know, and are not, you know, they're not into some sort of big luxury miles, they're going to be much better off doing the mileage deduction. You can do mileage, or you can do gas and all the expenses. You can't do both.
Okay. Thank you so much. And thank you for watching.